Let's talk some consumer staples. As shares of Coke haven't been doing too great. We're going to do a little trading, take a look at the earnings. Tom Wyatt's here with me in the studio, host of Fast Market. Rob Moskow joins us, analyst at TD Cowen. Rob, Coke has seems in a tricky spot, and now when we're hearing about aluminum pricing and tariffs, I wonder if it gets trickier, does it?
You know, Coke has the stock has fallen along with the rest of staples. I upgraded it at the start of this year because my view is this: you should turn more positive on high quality names like this with great long term potential, are executing at the top of its game and are creating real value. The aluminum tariffs, it will affect their bottlers, and there will be some pass through of cost onto Coke. But what gives me confidence, especially in the North America market, is they always do a very good job of passing through pricing in North America to the consumer to offset costs like these. A lot of other categories, I get worried about that because of the elasticity impact. But as you can see in carbonated soft drinks in North America this year, they passed through pricing and volume was up. Maybe that doesn't happen again this year, but I got to say that that's a sign of creating value in their everyday marketing and strong category dynamics for them.
Category dynamics. Tell me more about that. What right now does Coke have any ace up its sleeve?
37% of their sales are in the U.S. What's really driving volume is Fairlife. Fairlife is their protein beverage. They bought the business, and distribution growth and strong velocity have been flowing through the results. It is spot on with consumers who are shifting to higher protein diets, consumers who are on GLPs. By our math, it's adding 2% to the volume in the U.S. That relationship. Also, Monster, a great relationship with Monster continues. The energy drink category is starting to come back, and Monster's execution is improving too in the United States.
I guess I'm not on the protein shake train. I didn't even know about Fairlife, but I just looked it up, and I recognize the beverage, the Core Power.
Core Power.
Yeah.
Core Power is really
Monster, right. I'm definitely familiar with, but I thought the energy space got kind of like saturated once Celsius peaked back in May and has like been crashing. I thought part of that narrative was that there was just so much going after one market. Has that cleared out a little bit? What does Monster growth look like at this point?
The category in the US anyway has gotten back to growth, like low single digit, almost mid single digit growth. The saturation that we saw in energy was really outside of Monster and Red Bull. A lot of these brands are coming in with vitamin riched, good for you, helps your workout kind of positioning. They did a great job growing the category. They brought a lot of new users in, a lot of women entered the category for the first time. But what we're seeing in the data is that Monster and Red Bull have done a great job of getting back to their core strengths. Red Bull introduced a sugar-free version. The saturation is really happening in the 30% of the category that's outside of Monster and Red Bull. And that gives me confidence that Monster will still grow in 2025.
Okay. So at this point, Coke and the tariff story kind of sounds like you're focused on some of the product momentum. Does any of it get derailed if we do slap big tariffs on aluminum? What kind of insulation do they have to those input prices?
There's more that we don't know than what we do know. The one thing I would say again is it's going to affect the U.S. market, and U.S. is only 37% of the business, and it affects their bottlers. Coke is a syrup company, so the bottlers will pass on that cost to the syrup company, probably not all of it, and Coke will have to figure out what to do. They'll either raise prices, maybe they'll absorb some of it. The math is tricky to figure out at this point. But again, my confidence lies with the pricing power in the category and the value that is pretty clear in carbonated soft drinks. I think that's why consumers bought it in 2024, and even though prices were higher.
All right. Good stuff, Rob. Thanks. Strong case made here. Appreciate it.
Sure. Thank you.
Good stuff, Rob Moskow from TD Cowen. And, I guess I hadn't heard it described as a syrup company before. I like that, especially after hearing about syrup sandwiches last night.
Yeah.
What's up, Tom? You want to do some trading?
Yep. Coke trading, going into earnings. Option market's priced in less than 3% move in the shares. So not a lot of implied volatility. This is one of those staple stocks, right, that doesn't typically move that much. Now it's pulled back about $10 from all-time highs that we saw just a few months ago. So it's been under pressure. It's got a 3% dividend yield. So that's what I structured my example trade around on here in Coke to take advantage of that dividend yield and then creating some yield by selling a call that's out of the money to the upside. I looked at a cover call strategy where for every 100 shares of stock you buy, you sell an out of the money call. I looked at selling the March 7th weekly options that expire in 25 days, sell the 66 strike call. The option market, as I mentioned, pricing in about a plus or minus 2.8% move. That's about $1.80. That kind of equates to that maybe this short call on the 66 strike will still be out of the money at expiration. But for every 100 shares stock you buy, you sell one of the May 7th weekly 66 strike calls. You're paying a debit of about $63.30 on that. So you're buying the shares at a discount. You get to collect that dividend yield of 3%. And then as you get closer to expiration over the next 25 days, you'll be able to roll or adjust that short call, creating more credits. That's going to increase potential profitability and continue to lower that break even. But pretty conservative type of strategy here where maybe the stock doesn't do anything and you can still profit on this type of trade. It does limit your upside on a cover call strategy, but at the same time, allows you to collect yield on not only selling calls against your long stock, but that dividend.
Okay. All right. So looking for, little safety play.
Yeah.
Buy stocks.
Paid to wait type of strategy.
All right. Fair enough.
Yeah.
What else you got? You got some in Pepsi?
Pepsi, too. Near 3-year lows on this stock post earnings. Yeah, it's been pretty dismal for the stock, down 5% so far this year, like I said, near those 3-year lows. So if you think the stock's going to rebound, they don't have earnings again until the end of April. So I looked at something with a little bit more duration, pretty straightforward, bullish call vertical here if you think the stock's going to rebound. And it doesn't need to rebound like 20% either. You're just looking for a move up to one portion of this vertical. So going out to the April monthly cycle, so 66 days to expiration. We're going to buy the 140 strike call, and then to offset some of the costs on that bullish call purchase, we're going to sell the 150 strike call. So a bullish $10 wide call vertical. You're paying roughly about a $4.80 debit on it. There's your risk, your potential reward. So it's almost a 1-to-1 risk-reward ratio if the stock goes above 150 at expiration over the next 2 months. They've got earnings, as I mentioned, on the 22nd. The break even for this, if you pay $4.80 debit, $144.80, that's 1% above the current share price. So like I said, you don't need a monster move to the upside. You just have expectations over the next 66 days that it's going to go up towards that 150 strike. And because you're buying the vertical, it gives you a little bit more flexibility as far as trade management goes also, because if the stock just pops, within 20, 30, 40 days, you can start parsing out of your position depending on how many contracts you did, or just wait and hope that it continues to move higher and goes above 150 at expiration.
Okay. All right. So kind of a hope trade here for Pepsi. Take a stab.
Offsetting some of the costs. Instead of just buying the at the money or the slightly in the money 140 call. Yeah, offset some of the costs by selling the 150, where hey, I think it's going to go higher, but it doesn't need to explode to the upside back to 160 or 70.
Just needs to find support at $140.
Yep.
Okay.
Yep.
All right. Thanks, Tom, for the trades. Appreciate it very much.